Good morning, everyone, and welcome to those of you in the room and to those of you on the webinar to Ryman Healthcare's half-year results presentation for the 6 months to 30 September 2017. For those of you who don't know me, I'm David Kerr. I'm the Chairman of Ryman Healthcare. To my right, we have Gordon McLeod, our Chief Executive, and then beyond him, David Bennett, our Chief Financial Officer. So this morning's format will include a bit of an overview from me, followed by presentations firstly from Gordy, and then from David. Gordy's going to give you a snapshot of the operational progress during the half and some views on what's ahead and his experiences in the first 5 months as Chief Executive. And then David will give you some greater detail on the financial results. At the end of the presentation, we want to open the session up for questions, obviously, from the floor. And following that, we'll take questions from any callers who are on the conference line. We'll bring a microphone to those of you with a question in the room so that everyone can hear, but also so people on the webinar can hear you properly as well. And for those of you listening on the phone conference or a webinar, the operator will advise you when you can ask a question. Look, and we would anticipate wrapping up sort of 9:40, something like that. So look, as a board, we're very satisfied with the first half result. The numbers pretty much speak for themselves. And David will talk through them in greater detail shortly. But it's been another pleasing half year, and we've got some great villages on the way and have made good progress on a number of fronts. The headline numbers are that the underlying profit increased by 11.4% to $85.2 million. The IFRS reported profit, which includes the revaluations, is up by 8.4% to $202.6 million. The interim dividend has been lifted to 9.5 cents a share, and the assets have increased to currently sit at $5.3 billion. And possibly most importantly, we're now in a position where we've got 14 new villages in the pipeline, which includes a great new site for our 7th village in Victoria. Now, as a board, we've always taken the view that if we, the team at Ryman, can get our care and resident experience right, then the financial results will take care of themselves. And this result today, which builds on 15 years of continuous profit growth, I think demonstrates that. So I'd just like to take a moment to talk about care and why I've been so heartened with the progress that we've made and what is really at the very core of what we do as a business. Over the years, a lot of people have mistaken us as a purely property development company, and this is not the case. When anyone asks me what Ryman Healthcare does, I always say we're a care company. It's simple. We care for older people. We take that responsibility very seriously, and we believe it's a privilege to look after older citizens. We've been a care company since we first started, and nothing has changed except the size of the company and the market that we operate in. We know as a board that if the team can get that care side of the business right, everything else will follow. It's all about the residents. The care we provide must be, in the words of Kevin Hickman, our co-founder, good enough for mum. That was the genesis of the company, and it's still the primary driver. Many of our residents are particularly vulnerable, and it's a statement of the obvious, possibly. But in that situation, humans need another human, someone to listen to them, to be with them, to feel connected to, and basically to care for them. I think that the familiar face, a caring touch, a smile, all combine into an encounter which is what makes a person feel cared for. Care is what we do, and you could say that our strong focus on care is a point of difference and what sets us apart from many of our competitors here and in Australia. 55% of our village offering is care-based. More than 5,000 residents receive care tailored to their needs in either service departments or our rest home, hospital or dementia care units. The security of knowing that there is great care on hand if needed is one of the compelling reasons why the other 45% of our residents enjoy living in our village so much. We provide them and their families with the peace of mind of knowing that we're there to help if they need us. This focus on care, as you can see from the slide, is what makes us the biggest player in this area in the industry, with a much stronger skew towards care than our listed retirement village rivals. Our residents are predominantly in their mid-80s and older, so you can see why certainty of provision of care is so critical. I've served on our Clinical Governance Committee since its inception, along with two other director colleagues and Professor Tim Wilkinson, a geriatrician and professor at the Otago Medical School. And it's our role to see that the team make sure all our clinical indicators are heading in the right direction, and I can assure you that they are. My Ryman, which Gordy will talk about in a moment, has already made a big impact, and I see its potential for improving the care experience for residents and staff is enormous. Apart from improving our ability to see that the right care is delivered at the right time to the right person, we're also releasing our staff from being scribes in an office to being able to spend more quality time caring along the lines of what I've just outlined. One Chart, our medication administration system, which we introduced in 2016, has had an immediate impact on the accuracy and efficiency in medication delivery. On top of those innovations, we've invested further in our staff training and in improved internal audit systems, which mean our care staff are constantly able to learn from one another and focus on improving what they do. All of this has had a really practical effect upon our residents. We know that the care is continually improving. What's really heartening is that we can measure these results, because Ryman Healthcare now has 15 villages with 4-year audit certification from the Ministry of Health. Now, 4-year audit certification is the gold standard of any external audit. It shows that our systems and practice are consistently high enough for the external auditors to give such lengthy certification. And you can see from the slide that we're actually leaders in this certification. They're not just a blip. This is the result of years of hard work by our staff and a focus on continuous improvement. And our focus will continue to be on improving. Earlier this week, we had a board meeting. And when I was reflecting on the content of that board meeting, it was predominantly focused on where the company wants to be in the long term and on our organisational health. Yes, like all companies, we have to look in the rear vision mirror from time to time, but our long-term orientation is much more important. I think it's fair to say that as a board, we were seeing lots of danger in short-termism, if there is such a word. Too much focus on what we need to do in the first half or the second half or what the second half is going to deliver runs the risk of us not delivering a well-resourced, resilient business with a long-term growth path. We feel strongly that this is a long-term growth company. There's plenty of research to show that long-term growth companies can be identified by having steadily increased revenues, low volatility in those revenues, and they tend to have a focus on value creation fundamentals rather than the next announcement or the next briefing. Long-term growth companies also will tend to have steadily increasing total shareholder return and increasing market cap. And I suggest these are all features you can see in this company. They also tend to invest back in the company in R&D to a much greater degree, irrespective of the year-to-year variation. So our continued investment in our staff, our leadership, our program of refurbishment of the villages, and investment in new technologies like Ryman and One Chart are actually ways of us demonstrating that commitment. Every village that we add is another financial engine for the company, which enables us to fulfil the purpose of caring for older people, also to continue to invest in improving the resident and staff experience and generating increasing shareholder returns. We've got a record of delivering to shareholders exceptional financial results over the medium and long term, and we're very proud of that. We have exceptional staff and senior management, many of whom have been with the company over a long period of time. And I know that they're also totally committed to the long-term success of the company. So, in closing, I would just say that the board and leadership of the company see ourselves as having a long-term view for this company, which is exemplified by a deep commitment to the residents and their care. It's also exemplified by a similar commitment and continued admiration for our staff and the culture that they embrace, and a continued determination to deliver great financial results to shareholders over the medium to longer term, and being able to double, as we've said often, our underlying profit every 5 years. So I'd like to hand over to Gordy.
Thanks, David. Good morning, everybody. So I've been in my role for 5 months now, and I'm loving it. This is my 12th year at Ryman, so I know my way around pretty well. But I decided when I began to adopt our co-founder Kevin Hickman's advice, of management by walking the shop floor. I've already visited lots of villages with the goal of getting around all 31 well before the end of my first year. So far I've done everything from medication rounds, but don't worry, I was just watching, to helping out on the afternoon tea trolley in the care centre, sitting on nurses' handovers between shifts, participating in resident AAA exercise classes, but I haven't got abs yet though, and also having a good look through our kitchens and laundries and having 2-course lunches with our service department residents, which is probably why I don't have abs yet. And no, I haven't been watching Undercover Boss. I'm probably pretty hard to disguise, I think. I've met a lot of staff, heard their stories and their thoughts, and enjoyed the company of residents. They're always quick to tell me what's working and what isn't. Just one of the things that's really stood out to me has been the feedback from residents about our new menus. Residents now get 3 delicious choices for their main meal, all cooked fresh on site. Our latest survey results show the highest level of happiness ever for our retirement village residents, and our new menus have been a big driver of this. We've also invested in a revamp of how we train our staff to assist resident movement in the care centre. We call it Ryman Moves, and it's been really well received by our staff as a way to make our people safer. The other standout for me is the frequent comment I get from residents everywhere I go. Residents they proactively come up to me and they want to tell you how great the staff are here. They want to tell you about how they're always smiling and happy and kind. And I have to tell you, I'm always very, very humbled that our staff give a huge amount of themselves every day to our resident to make that experience, and I'm very grateful for that. I've also spent a lot of time visiting our construction sites. We've put extra resource into our health and safety teams at all sites around the country. We're trialling additional measures to protect our teams when working at heights. And we've also rolled out a new health and safety system. And I have to say, it's amazing actually what our construction teams achieve when you visit a site. Often in very trying conditions, like the 4th wettest winter on record that Auckland's just endured. And look, overall, there's always a lot of stuff to work on. We're never happy with where we're at. But the overwhelming sense I've got from my visits is that the investments we're making are paying dividends right now, as well as setting us up for future growth. One of the biggest investments of all is My Ryman Care. In fact, I'd be surprised if there was a bigger investment in improving the care of residents and the work experience of our care teams anywhere in the sector here or in Australasia. And we've actually finally started the revolution this year with the first village going live in July. My Ryman Care is a game changer. It means that our care staff have much more time to do what they signed on for, looking after residents. And of course, getting rid of dreaded paperwork. After My Ryman was trialled at Diana Isaac, the first village to go operational was Anthony Wilding in Christchurch, which happened in July. We picked Anthony Wilding because it is a large 150-bed care centre with rest home, hospital and dementia level care. And it's also a really well-established village. It's opened, I think, when I joined in 2006 or just before. So there's plenty of ingrained habits to change. The clinical manager in charge at Anthony Wilding is Jeannie Sales, and that's Jeannie on the left-hand side there in one of our lovely new uniforms. Jeannie has been nursing since 1976. It's quite amazing, eh? I was 6 at the time. And she's really proud of the 40 years that she spent caring for people. She took to My Ryman like a duck to water. For nurses like Jeannie, the beauty of My Ryman is that the app contains everything caregivers and nurses need to know about their residents at a glance in their room, combining the critical clinical information with things as simple as how they prefer to have their tea. Jeannie and the clinical teams used to spend hours writing up 20 pages of beautifully composed paper-based care plans for each resident, most of which would sit in the nurses' stations. But the reality was that the caregivers and nurses struggled to read or absorb them properly. Updating notes was tedious, shift changes were long and involved, and as you can see right throughout healthcare actually, right into the public sector, we had slowly bogged down our system of record keeping into a time waster. Not something real time, not something people-centred. Jeannie told us she's seen some huge changes over her 40 years of nursing, but nothing as good as My Ryman. It's captured the imaginations of our care staff because it's user-friendly. It makes a big difference to their lives and to those of our residents as well. And what I personally love about it is that so much technology change you see these days is done with the goal of replacing people. My Ryman does the opposite, in fact. It makes care far more personalised, and it actually increases the human touch. I want to acknowledge the work that Simon Shelley's put into My Ryman. He put in countless hours. Thanks, Simon, if you're watching. I'm sure you are. And our in-house team are doing a great job of turning the vision into a reality. We're live at 8 villages already, and the rest can't wait to get their hands on it. The plan is to complete the rollout by August 2018. We recognised a very significant milestone recently with our Group Operations Manager, Barbara Rainin-Rose, reaching 25 years with Ryman. That's Barb on the right-hand side of that photo. Barb joins Debbie McClure as a 25-year Rymanian on the management team. So although I've done 12 years, I'm still on trainer wheels, really. Barb brings the same energy, commitment and care to looking after our 10,500 residents that she had back in 1992 when we only had 300 residents. And what better way for her to celebrate 25 years at Ryman by leading the nationwide rollout of My Ryman Care. The other great success we've had in recent times is Ryman Delicious. That's the food revolution we talked about earlier. And that actually was Barb's brainchild. She wanted people to come to Ryman for the food, and she's managed it beautifully, along with the leadership of our food and hospitality manager, Andrew Gibson. Barb is one of the most experienced healthcare leaders in New Zealand, and I'd say that she's a Ryman icon. And she's still leading positive change throughout our villages. By the way, the staff member with Barb is Chris Beckett. Barb actually hired Chris as her caregiver 18 years ago, and she's still working for us at Ngaio Marsh in the hospital. Barb wanted to acknowledge Chris's service as well as her own. I'm very conscious that leaders like Barb do not grow on trees, and we're going to need a lot more Ryman leaders as we double in size every 5 years. We're building our teams, and we're in the midst of developing what we want it to become as one of the best leadership development programs around, called Ryman Leaders. Being a Ryman leader is a very demanding job. Whether you're a unit coordinator on a care floor, a project manager at a construction site, or a regional manager. And I want to ensure that our in-house development of people ingrains the Ryman culture of "it's got to be good enough for mum" that was established by Kevin Hickman, along with his tenacity and drive to achieve what he taught to so many of us. I thought I'd take you on a quick tour of what we're up to on the development front. So we've got a new slide there with 14 sites in the pipeline and 4 on the go at the moment. During calendar year 2018, the plan is to complete our sites at Birkenhead, Green Lane, Petone and Pukekohe. We're also going great guns at Devonport, Lynfield and Brandon Park in Melbourne, all 3 of which are underway, and we'd expect to welcome our first residents at those 3 sites during 2018 as well. Currently in the consenting process are Burwood East and Coburg in Melbourne, and also Hamilton back here in New Zealand. Ideally, we will be in a position to start all 3 during 2018, subject to consenting approval. And you can see we've got plenty of other sites in the design phase. So we're now well underway on our second village in Melbourne at Brandon Park, and here's a drone shot of that. What you can see in that photo is the sort of the main block and the care centre at the front there, and more to the top of the right-hand side is the first stage of apartments. The first apartment block is going up quickly. They only got started about a month ago, wasn't it? About a month ago, and that's the progress to date. And we've also started work on the village centre. When I visited the site recently, I was really impressed actually with the leadership team that Marty Osborne, who's our Victorian construction manager, has established. We've recently invested also in experienced on-the-ground development professionals, and we are expanding the concept and building design team, especially for Victoria. We'll welcome the first residents, coming back to New Zealand, we'll welcome the first residents at our Green Lane village in Auckland early next year. And it's going to look amazing on completion. We had a visit there with the board this week, and you can see why we've pre-sold so many already, because it's got amazing views back over the harbour, panoramic views around Auckland and back to Cornwall Park, and it's going to be an amazing village, I reckon. And it's sort of, when I see villages like that, it always reminds me that the development team do a great job of finding sites and getting them consented. We're also well underway at Devonport and Linfield, and we've held public meetings with each site in the community, and Debbie and I do those. More than 400 prospective residents and their families came along to hear what we have to offer, also along with a couple of competitors actually in their branded vehicles. Pre-sales for both have been strong. Those 4 villages I've been talking about, Green Lane, Devonport, Linfield and Brandon Park, so they'll be coming on stream in the coming year, and when fully built will be home to more than 2,000 residents, adding to our Ryman family. As David mentioned earlier, the development team has secured a new site in Victoria at Mount Martha, which is on the Mornington Peninsula. There's a good aerial view of its location there. The peninsula is home to a large retired population, and Mount Martha was identified as an area with a shortage of care beds. And of course it adds to our presence on the peninsula because we also have a site in Mount Eliza. It's a great site for a medium-sized village, and we now have 7 sites secured in Victoria. And in fact the Victorian Land Bank is now matching that in New Zealand. We'll continue to add to the land bank to keep the pipeline going, and to ensure we establish an annual rollout of 2 villages per annum in Victoria to match New Zealand. And I have to say there's plenty of new sites on the radar. We saw a few at the board meeting a couple of days ago. We have actually learned a few lessons though from our experience of getting our recent large-scale villages underway. To be frank, they've taken longer than we would have hoped, and as a result we've added new resource to our design and development teams, and we've changed the way that we approach community relations. And we have a much better working relationship with Auckland Council in particular. And that's where we've got 5 high-value new villages in the pipeline. Resources of every kind have been under pressure in Auckland, and that includes consenting staff at the council. We've worked collaboratively with them to ensure our consenting processing is better streamlined, given the significant role that Ryman plays to both increase and free up housing supply, and also to build critical healthcare infrastructure for the region. We've added a new design team based in Auckland, and we've reorganised our teams in Christchurch with the aim of speeding up the throughput of consented designs. So over and above the 4 villages underway, we've also got another 10 villages in the land bank to take us well out to 2022. We're keeping an eye on the property market, of course. The fact remains, though, that residents moving into our villages are typically in their late 70s and beyond, and they make their decision based on health needs and security rather than on what the housing market's doing. Our needs-based demand was affirmed in the first 6 months with another really strong performance by the sales team. So whilst the New Zealand real estate market volumes actually came back 20% in those first 6 months, our resale volumes grew by 12%. So that really shows that what we're doing is really de-linked from the sort of volumes, transactions you see in the housing market in general. And also couple this with the fact that our forward order book with unconditional new sales for villages under construction, they're actually at the highest level that I've seen them in the 11 years I've been at Ryman, at over $200 million. So we're in a strong position. We've also just increased our pay for our village staff again following the equal pay settlement, and we've also introduced improved benefit packages for our staff as well. Staff are sharing in our success, and we got great feedback from the review that we did in October. I must admit I remain concerned about immigration settings, and we will continue to lobby at a government level to make sure that our immigration team members at Ryman are recognised for the contribution that they make. We'll always fight to ensure that our Ryman family members are fairly treated and are recognised for the vital work that they undertake for our residents. So that's just a brief overview of the past 6 months and a taste of what's to come. You can see there's plenty going on. And I think when I reflect on it, it's just amazing to me that after all this time at Ryman, it feels genuinely like we're just getting started. Victoria, you look at that, it's only in its infancy for us, and we've already got 7 sites secured there now. And even in New Zealand, we're just at the start of the most fundamental change in demographics that we'll ever see, and that endures for decades as it does in Victoria as well. And so that's why we're investing so much in people and innovations right now on both sides of the Tasman. And then just finally, a big occasion for Ryman during the half, we became the official sponsor of the Coburg Lions Aussie Rules team. The Coburg Lions ground backs onto our new site in Coburg, and in the photo there you can see Sebastian from the left, who's one of the club officials. We've got Debbie McClure, Andrew Mitchell, Tom Brownrigg from Ryman, and also Keith, who's one of the club president there as well. So they're our neighbours. They're very supportive of what we do. You can see the Ryman logo in the background there on the scoreboard. So we look forward to learning a bit more about Aussie rules and supporting the Coburg Lions over the next winter. So overall, it's an incredibly exciting time, I reckon, to be part of Ryman, whether you are a member of staff, whether you're a resident with one of our villages or moving into one of our villages next year, and also for shareholders. It's really we're just at the start of getting going. So thank you very much. I'll hand over to David Bennett now. I will just say for poor old Dave that he has man flu. And so he's coughing and spluttering a bit, but he's going to play on like Colin Meads.
Thanks, Gordy, and good morning. Our underlying profit of 85 mil is an increase of 11% on last year, with the big driver being resale gains, which were up 55%, and management fees, which lifted 24%. We had a satisfactory lift in our reported profit, up 8% to 203 million. This was on the back of good trading and valuation gains of 118 million. The valuation was up, firstly, because our valuers lifted our 5-year plus long-term growth rates from 2.8% to 3.4%. This compares to the long-term average actual house price increase of 6.5% since 1992. So we would view this as conservative. In the short term, the growth rates reflect a flattening housing market with an average of 1.9% per annum over the next 4 years. Secondly, we added 137 new units to the valuation. And finally, prices lifted 4%, reflecting strong demand for our village offering. Resales have been a big driver of earnings this half. The resales bank of gains still to come increased slightly to 770 million. These pent-up gains mean we can expect our resale earnings to keep on going, even if the housing market was flat for several years, because volumes increase as villages mature. Deferred management fees also reset to new price levels with each resale, creating a compound effect. Strong resale earnings are also a function of growing demand, with volumes increasing 12%. Only 46 units, or less than 1% of our portfolio, were available for resale at the end of September. Care demand was very high as well, and we averaged occupancy at 97%. The aged care sector in general is averaging around 87%, so we are significantly outperforming the market. We have a very strong financial position with total assets of 5.3 billion, and shareholder equity has lifted significantly to 23%, by 23% to 1.8 billion. Our debt has increased to 945 million as we continue to grow both the land bank and invest in new villages due to open in 2018. Our debt to debt plus equity ratio is 34%, which is consistent with prior halves, so our debt is growing in line with our balance sheet. We regard it as productive debt. We invest the bulk of it in new villages where we recycle capital, which establishes a growing tail of recurring cash flows. We continue to have very supportive banking partners, and we have recently added the Bank of Tokyo Mitsubishi to our syndicate. Our total bank facility is now $1.25 billion, which means we have over $300 million of bank headroom. Our development margin for the half was 17%, which is lower than our target range of 20 to 25%. This is a direct result of Bob Scott and Petone, which we had previously advised as a lower margin site due to the seismic requirements. Excluding Bob Scott, our development margin would have been 20%. For the full year, we're expecting our margin to be within the target range. Affordability of our units is something we monitor very closely. This chart shows you what I mean. Our residents in Auckland and Melbourne free up significant amounts of capital when they move into a Ryman village, so there remains plenty of price headroom for incoming residents. With 14 new villages in the pipeline and a large resales bank, we can expect the capital sums at our villages to more than double over the next 5 years. This will grow from $2.6 billion today to over $5.4 billion. This growth reflects not only a ramp up in Melbourne, but also the economic benefit of building in higher value locations. A significantly larger capital base lays the foundations for much bigger recurring cash flows from both resales and DMF in the future. On top of this, we get increased care earnings from building more aged care beds, or as David described it earlier, each village creates a new economic engine to power the growth of the company. What triggers our ability to grow in this way is simple. It's our business model of recycling capital at each village. Since listing in 1999 and raising $25 million, we have now invested $2.8 billion and paid out a growing dividend stream to shareholders of $630 million. But we've never had to raise any fresh capital. So the outlook for the full range is an underlying profit in the range of $195 million to $210 million. And before I hand back to David, I want to highlight to you that we have made some additional disclosures on resident average age, our debt composition, valuation assumptions, investing cash flows, and average tenure of vacated units within the appendices to our results presentation. Thank you very much, and over to David.
Thank you very much, Dave. That's great. You can see he's not in the best of shape today. So, look, this is now a time for some questions, and if we take the questions from the floor first of all, and maybe if we could just have a microphone for any questions so that they can be well heard. So if you'd just like to raise your hand if you have a question. Yes.
Jeremy Simpson at Forsyth Bar. Just in terms of some feedback on the consenting progress in Melbourne, it'd be interesting too on Coburg and Bearwood East and how that's going, and I guess relative to the the lengthy process there was at Brandon Park. Yeah. And just also just confirm what, again, I missed it when you were in the prezzo, what new first residents you're expecting to get from what villages in in the second half, basically.
Yep. Okay. So consenting progress at Bearwood East, we're in good discussions with the local council there. They've been supportive of our plans and what we're planning to do. One of the things which needs to be worked through for the site, which won't take place until about February next year, is that the development plan overlay, which Fraser Property have control of for the whole site, because we bought a parcel of land on that site from them. They need to get that approved from the council for our development to be able to proceed. So we've submitted all the plans and everything that we need to do. We're getting good support from council, and we're also just waiting for that technicality to work its way through as well. For Coburg, we're actually presenting to the local councillors before the end of this year. We've got a date locked in. At that meeting, we may or may not know exact time frame after that, but we would be hopeful for a positive response. The officials at the council have been really positive with what we're planning to do, and that site had pre-approval for a reasonable number of stories on site, which we've respected, and we've also been working with neighbours as well to make sure they're comfortable with what we're doing along boundary lines. And of course, one of the neighbours being the Coburg Lions are happy with what we're doing as well, bringing new sort of supporters along to the club. In terms of residents moving in the second half of the year, we would expect the first residents at Green Lane to move in the sort of February, March type time frame to the apartments that run along the back of the site there. At Linfield and also Narrowneck, there would not be any residents moving in during that time frame. They're more sort of July to September type time frames for the initial apartments there. At Birkenhead, we'll have more residents moving in between now and the end of March as well, but not for the final stage. Stage 3 will be into the next year. And Brandon Park, we would expect our first residents to move in around about July next year. But we'd expect the work on site and obviously the unconditional contracts to mean that we would be able to recognise some of that in our underlying profit for 31 March.
Great. And just one other question. Just some comments around operating costs, pressures, and I guess the equal pay situation, and now the minimum wage situation. How are you sort of feeling about that and the impact of that on margins?
Yeah. So the equal pay settlement, which purely related to caregivers in our villages, was fully funded by the government. We have actually reviewed our pay levels subsequent to that. We have actually lifted our nursing pay and also the pay for our auxiliary staff at villages as well. The ongoing cost of that is, in the region of, I think it was annualised at about sort of 5 million per annum, that uplift. And obviously one of the things that we do at our villages, because they're well above government specification and we provide outstanding offering, is that co-payments obviously from residents fund that wage increase in terms of new residents coming in. And in terms of the minimum wage of $20 an hour, which has been mooted from 2020 or 2021, whatever it is, the majority of our staff at our villages work in care centres, So the age-related residential contract, or the ARC contract, which governs how our care centres work, have a specific clause that if a government-mandated change outside of the sector's control is put in place, which materially increases the cost base of a provider, then it's the government's responsibility to fund that. So when those calculations are worked through and how that phasing works through, generally our expectation is that the majority of that cost increase will be funded. And look, it's good. It's just generally good to see staff on a positive track for better pay, whether it be through equal pay, the recent pay review that we've done. And so that's why I think it's good that it's good that Ryman is profitable, and it's good that we're able to invest some of that profit back into our staff and share that with our staff.
Thanks for that.
And hand in hand with that, we've seen staff turnover decrease, which is really good. It means that people are enjoying their work, they're staying with us, we're getting the benefit of the extra training they get.
Daniel Frost, Macquarie Bank. Just a couple of follow-up questions. The first one, I don't suppose you can give us some numbers as to what sort of completions you expect in the second half?
No, well, there's the focus, the 3 sites that will be the most material contributors to the year-end result will be at Birkenhead, Brandon Park and Green Lane. And at the bottom end of the range, we've allowed for the fact that at maybe 1 or 2 of those sites will have less progress than at the upper end of the range. At the upper end of the range will be a better run-on in terms of build. So it's early days yet, Dan. A lot gets done. I've found at a site even between sort of Tuesday and Thursday sometimes. So we just have to see how that pans out. But that's why we've given a range, and also because of the fact that resales, resale gains are about $50 million in the first half. Each resale on average generates a capital gain of about $135,000. And so the number of resales that come up can have a reasonable impact as well.
Sure, thanks for that. And just into 18, I don't suppose you can give us any sort of feel as to what sort of completions we should expect in 18?
In 19?
Oh, sorry, 19.
Yeah, 19. FY19. So FY19 I think might be looking reasonably good, actually. I don't really want to dwell into too much detail on it, though. We'll talk about that in May, eh?
Fair enough. Yeah. Just on the wage increase that you talked about, that was annualising 5 million. When did that get instigated?
From the 1st of November.
Great, thank you. And finally, just a question that always gets asked just on the housing market. What sort of drop in sales rates in the housing market would we need to see before you'd start to see some impact in your results?
Yeah, it's interesting. In the first 6 months of the year, you'd probably regard it as a reasonably material movement that volumes in the market dropped 20%. That hasn't been seen for quite a while. Now, our resale stock, as Dave said, was only down at 46 units. We get about 70 to 80 units come available for resale every month. So 46 units available is, well under a month's sort of trading stock. So I think in those sort of conditions, it shows the needs-based model right across the group and the demand at existing villages, Dan. In terms of new sites, fact of the matter is right now we're sitting on the highest number of pre-sales and pre-sale contracts that we've seen. So I guess the initial part of the market slowdown is a 20% drop in volumes and we're trading well. We've not had to move pricing at all. It's probably instructive to look back to the global financial crisis, I suppose, which for us during a 6-month period between 2008 and 2009, the housing market in New Zealand, the volumes dropped by 2/3. The days to sell doubled from 30 to 60. And prices dropped 10%, and it all happened in a 6-month period. And during that time, we didn't have to move our pricing because we always take a reasonably conservative view on pricing, and you could see from the slide that Dave showed that there's considerable headroom between the price that a resident would expect to get in a suburb and what we're currently charging for a service department and independent unit. So look, I think that having traded, when I remember trading through that, we were just very, we were very careful all the time. We only committed to new stages where we'd sold down the previous stage, and because we were conservative in pricing, we didn't have to move much. The other big thing about us, I think, is we've talked about the needs-based. Dave has talked about that, but we also build in villages which have strong demand. The areas where we build villages in, they're not sort of fringe areas. So what that means is that residents are moving from a well-established area which is in good demand through good times and bad. So even during the GFC, residents are selling their homes fine. And the reason for that is that ultimately you have about 95% of the population who are employed in reasonable economic conditions, and they have things like babies. They have extra children, they want to move into a family home, and they want to move into areas where there's established infrastructure, schools, playgrounds, not out to the fringes necessarily. So as a result, the stuff of life, I sort of call it the stuff of life, continues to happen. Residents will still be freeing up capital, the health needs will still be there, and so we would expect to just trade through like we did prior in those, in the past over the worst financial conditions since the 1930s.
I think the other thing, Daniel, is that those sorts of situations in that environment often will give us lots of opportunities around land that we wouldn't have in a more heated environment. So,
great, thank you.
Thanks, Dan. Good morning.
Hi, Ari.
Hey, just 3 questions from me. Firstly, could you just give an update in terms of extending ORAs into care? I know it's sort of been a topic on the agenda for a wee while. Just any update on your thinking on that?
Yep, so just for the broader audience, we get capital sums in care in Victoria, which is a key part of the economic appeal, I guess, of expanding into Victoria. In New Zealand, we're still continuing to run with a co-payment or room premium strategy. It's really well understood by the market, and it's providing us with reasonable returns to cover the shortfall in government funding that exists in aged care, in the aged care funding model. We have looked at doing capital sums in care in New Zealand, and we're just not in a massive rush at the moment, Ari. The premium co-payment model is well understood. I think there's some regulatory issues which need to be sort of worked through a wee bit more. So at the moment, to do it under the current regulatory environment, it would be under the Retirement Villages Act with needs for things like AGMs and complex disclosure statements and that sort of thing. And we're just thinking through whether that works so well for an aged care resident. The bond model in Australia is sort of a more simplified model, and I think it's clearer for people.
No, that's great, thank you. Just on the bank facilities, just a quick one. Can you just, across the 1.25 billion of funding, just give us the tenure of the debt?
Yeah, it's 3 year.
The whole lot?
Yeah, and that's been our approach. I remember a few years ago, reluctantly increased it from 2-year tenure to 3-year tenure because it had had an increase of line fee associated with it. We've always seen it as working capital funding, Ari, so we've sort of worked on the basis that over roughly a 3-year period we would pretty much work out almost all of the debt if we were to stop developing, which, by the way, we're not. So we see the tenure as really working capital related, and it reflects that.
And just in terms of hedging, are you still running low hedging from an interest rate perspective?
Yeah, we have. Yeah.
Cool. And then just the last one for you, perhaps, David. Could you just restate what the change in the long-term growth rate was in the half, and whether there was any change in the discount rates?
So, excuse me. So there was no change in the discount rates. The long-term changed from 2.8 to 3.4% on weighted average.
Thank you.
Any other questions in the room? John. Yeah.
John Boscown. Gordon, you discussed in some detail the planning stages for the next two of the Melbourne sites. You haven't commented on the New Zealand sites. Yep. I've got a number of questions relating to New Zealand. Sure. Specifically, the first one, Hamilton. You've talked for some time, probably at least the last 12 months, about starting Hamilton very soon. Mm-hmm. Could you give us an update on the resource consent process in Hamilton? Yep. Secondly, could you give us an update on the design process for Lincoln Road and Hobsonville, and when you expect to be in a position to lodge resource consent applications, and how long you might think that take? Yep. And then finally, I attended your public meeting in Takapuna recently, as you know, yep. And I hadn't been aware until then that there was an old brickworks on the Devonport site, and it's sort of subject to archaeological excavations. And visiting regularly, I know that there's been virtually no movement or no construction activity on Devonport sort of since April, when you got resource consent. Yeah. I just wondered when the archaeological work on Devonport will be completed, mm-hmm. and when you actually expect to start sort of progress, or Linfield's obviously more underway than Devonport.
Yes,
Thanks.
It is. Yeah. Thanks, John. I wrote all those down, actually. I would have forgotten to answer all those off the top of my head. Okay, so let's start with Hamilton. We have a hearing scheduled for Hamilton with the council in February next year. And that was notified by the council on a limited notification basis. And we'll just have our usual experts appear before the hearing. Our development team feel that we've got an excellent proposal that sits very well on that site. It's a beautiful location, River Road. You've been to the site, so it's really well positioned for Ryman Village. There's more need for that, for critical health infrastructure in Hamilton, and it has taken longer than we would have wanted to get to there. And when we look back on it, my view is that we were just under-resourced in the design and consenting area internally inside the company. If you go back sort of 12 to 18 months, and we weren't able to do enough things in parallel. So when I was, talking earlier, that's why we're investing in more design and consenting resource, both within the sort of conceptual design area, but also the building consent design area as well. Because ultimately we're on a path to pretty much double our build rate in the next 2 to 3 years. So we just need more people. When you look at that sort of line of villages that are coming through, we're keener that we're able to progress more things in parallel rather than sort of sequentially, if you like. So we acknowledge that Hamilton has taken longer than we would have liked, but the hearing is February. The next one was Lincoln Road. So we're currently designing that at the moment. That's actually in a reasonably advanced design stage internally. We've engaged all our usual consultants around traffic management, geotechnical and so on, structural engineering, and we expect to submit a consent for Lincoln Road hopefully before the end of this calendar year. And Hobsonville is still very much in the conceptual design phase at the moment, so that's still got some time to go, but we're looking to really push on with Hobsonville as quick as we can from here.
And the brickworks.
Yep, and the brickworks. So, like you, I have visited the Takapuna site, the Devonport site on a few occasions, and sort of, wished more was happening. The reality is that there was a Duda, a family brickworks there on site many years ago, and as part of our resource consent conditions, We have to excavate the bricks, uncover them. We have to document them, how they were found. We have to carefully remove them. We have to store them on pallets. And the bricks that are in reasonable condition, we will use them in the village as some sort of design feature or some sort of feature on site at the village. We've also had a community open day at the end of October there. About 250 people came along on a Sunday or Saturday to have a look at the archaeological dig that we were doing and talk to people about what we found, and that was really popular. And we're nearly finished that work. And when I saw Matt Hutchison yesterday, he's hoping to get into the first stage of apartment, proper excavation imminently, John. And and it has, again, we would have liked to have started more significant works there earlier, but we have to respect the conditions that we have to operate under.
It is a great site, John, isn't it? And it'll be worth the wait, yeah.
If nothing else, you've confirmed to me that you're proceeding on Lincoln Road ahead of Hobsonville, despite having acquired Hobsonville prior, which makes a lot of sense. Thanks.
Other questions from the floor? No, look, we might go to questions from people online. Are there any questions from there?
Thank you. If you wish to ask a question, please press *1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press *2. If you are on a speakerphone, please pick up the handset to ask your question. Your first question comes from Jason Hamilton from Accident Compensation Corporation. Please go ahead.
Morning, Jason.
Morning, guys. Just a couple from me. The first one, there's been some well-publicised construction cost inflation across the sector. I'm just wondering what you guys have seen and potentially in Auckland specifically over the last 6 months.
Yeah, probably the biggest challenge, Jason, is around resourcing. I don't know why I've looked at the speaker to answer your question, by the way, seeing as it's on the microphone. So the biggest constraint is really around resourcing. So finding really good quality people on site is always a challenge for the guys. That's why we invest in our own people, being the project managers, the site foremen and the leading hands, because we want to have strong Ryman leadership on site. Cost inflation hasn't been too bad in the last sort of few months, but if I think about it over, say, the last 2 years, there's certainly been a reasonable amount. But it's probably, I think for a lot of people building in Auckland, it's probably the resourcing that perhaps is the greater struggle.
I think the other thing, Jason, is that when we're building at a number of different sites in Auckland, it means that the subcontractors can go from one site to the other. We have some continuity in terms of the quality, and they enjoy working for us, so there are some advantages there as well.
Okay. And then secondly, just probably a more detailed question, but what's been the feedback from those residents in your aged care part of the business where they're not subsidised by the government, but sort of effectively had to fund the increased costs themselves? Yeah. And has there been any impact on what premium charges you can do in that environment?
Actually, we got very little feedback on it, Jason. So it's a very good question. What Jason means by that is that if you're not subsidised to receive aged care, those private paying residents essentially had to fund the equal pay settlement. And the Minister of Health at the time, Jonathan Coleman, actually made that very clear when the equal pay settlement was announced. But you know what? I think that a lot of families feel that if they're over the asset threshold and there's been a government change, which means that the people caring for their loved ones get paid better, I think most people have been comfortable that that's a cost that fairly sits with the user of the service. So we didn't get any pushback on that, and it hasn't affected our premium collection ability either.
Cool, great. Thanks for those answers.
Thank you. Your next question comes from Stephen Ridgewell from Craig's Investment Partners. Please go ahead.
Thank you, and most of my questions have been asked by the other analysts, but I just wanted to follow up on Dan's question just about price trends across the portfolio. Overall looks pretty solid. But just wondering, Gordy, if you could provide a little bit more granularity on what you've seen in Auckland versus the rest of New Zealand and Melbourne. I mean, have you been able to, has Ryman been able to achieve like-for-like price growth on units at mature Auckland villages over the past 6 months? Thanks.
Yeah, we have actually, but it hasn't been. It's been relatively muted because the majority of that price uplift has occurred over the last sort of 2 to 3 years. So pricing has been held firm and slightly up.
Great, thanks. And also noting your comment earlier that pre-sales demand is at record highs, which is great to hear. Can you just comment perhaps on the pre-sale demand you're seeing at Brandon Park? I mean, previously you've commented that it has been strong. Any granularity you could provide there would be helpful.
We've pre-sold well over 50 independent apartments so far. Probably the wrinkle there in the market, just as I said as a short-term thing, was that there was a lot of negative publicity about the retirement village sector generally in the last 2 months regarding a major provider over there. And it's just caused residents to just want to get up the knowledge curve a bit more about how retirement villages work and the terms and conditions. And it's actually provided us a great opportunity to explain the Ryman difference. So we have a one-page Ryman difference flyer. It basically summarises our key terms and how they differ from what you would typically see from providers in Australia. And certainly our deferred management fee at 20%, which we don't restart between units, compares to a range, but up to 40% in the sector there. Usually there's increasing weekly fees in the sector there. Ours are fixed for life. We have a continuum of care at a Ryman village, 5 different levels of care. Often at a competitor village, you'd be talking about either retirement living or nursing care, very few integrated facilities. So, and we, as you can see from Brandon Park, we commit to building the main block right at the start. So that includes all the community centres. So you do read articles in the paper there about villages that have been operating for some time and still to build things like the community centre. So I think these are kind of good moments for the sector and potentially for us, because it gets us to really explain the Ryman difference in more granularity. It sort of becomes more real for people, and it makes them understand the questions that they should be asking. And at the same time, Debbie McClure, who's our group sales manager and community relations manager, she's the president of the Retirement Living Council for Victoria. And given that we've only got one village there, sort of shows the sort of standing that she's held in within the sector. And she's been able to have, and I've joined her as well with discussions with state government officials regarding potential changes to the legislation there to give more consumer, more resident protection. And I think a really obvious one is to have independent legal sign-off for retirement village contracts.
Right, that's great colour there. And just on the theme of Australia, just in terms of the development update slide in the pack, it sort of looks like Burwood East is the next cab off the rank after Brandon Park, if you like. Is it, as it stands at the moment, would it be a reasonable expectation that we should be thinking about some units could be completed there in calendar year 2019?
I'm always reluctant to say, actually, because we haven't got a consent yet. So I feel like I'd be giving myself that commentator's curse of death when they say that someone's been batting well and they're on 99. So, but look, I'd hope to get underway there in the next financial year. All goes well.
Okay, thanks. Yeah, okay, that's helpful. And yeah, obviously I understand there's consenting issues you've got to navigate for all new projects, and that is what it is. But just in terms of the comment also on extra development resource for Auckland, can you just give a little bit more colour on the quantum of that extra resource?
Yep. So when I was at the regional office yesterday, we had 3 full-time new designers based in Auckland. We've never had design resource based in our regional office before. One of them is a very senior designer from probably one of the New Zealand leading engineering firms, actually, and he's developing a really good team around him. I don't want to suggest what the cap of numbers might be, because we'll see how they go. But we're looking to continue to add to that team. I think it will be also really good to have on-the-ground design resource in a city where we've got a lot of work on the go, and it'll just be a lot easier to sort of practically catch up with consenting officials at Auckland Council, rather than doing everything sort of by email and plain like we do at the moment.
Okay, and can you just remind us of the model in Melbourne in terms of development resource? Do you think you might need to do that in Melbourne as well?
Yep. So in Melbourne, what we've done is Andrew Mitchell, who's our development manager, he's recruited a lead development person for that market, who's very experienced in aged care and also just generally speaking in development. So he's going to be able to, he's sort of already hit the ground running. He knows a lot of people at the key councils we're dealing with, so he's got good pre-existing relationships. And we've got another experienced lady who's working alongside him. I'm not saying that's the end of the resource requirement, but having 2 senior people is certainly preferable to the presence of 0 that we had. And it means that Andrew's not having to basically drive our development process by when he can get on a plane and fly over there. We need to have people on the ground to make this stuff work. And so we're also going to be investing, for example, in a marketing person on the ground there. And we're just building up our presence in Victoria because we want to have a strong local team and not so much management by sort of aeroplane, if you like.
That will make sense. And just last one from me, just on the care or head office EBITDA, seems to have declined a little bit over the last year. Presume that reflects perhaps a touch of cost pressure from Terra Nova. Is that something that we might expect to see more of in the second half, given that wage quality settlement will impact the full trading period? I mean, is there just a touch margin pressure on the aged care business? It would be helpful to get some comments there.
So in the first 6 months of last year, the 4 big facilities we opened, they didn't really start to get occupancy coming through in a big way until the second half of the year. So the losses that we typically incur in new village startups didn't really sort of kick in much in the first half of last year. So whereas we were still very much in filling mode in the first half of this year. So we've sort of been dragged down a bit. The care earnings have been dragged down a bit in the first half of this year by those 4 new villages. They're all 120 bed plus, continuing to fill. But the good news is in the latter sort of last couple of months, and this includes October and November, is that the fill rate at those 4 villages is really starting to pick up really well. So we're making good progress on it.
That's great. That's all for me. Thanks.
Any other questions?
Once again, if you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. There are no further questions at this time.
Look,
I will now hand back.
Thank you very much. Look, why don't we have a cup of tea and a chat and have some informal discussion. Thanks for joining us, and we'll enjoy chatting for the next wee while.